Okay, so this is the lesson on insurance. Now, well, the first question is, what is insurance? Insurance is basically a form of risk management where policyholders pay money so that they can get a large sum of money in the case of a specific event. It's defined by the policy, but essentially what this is, it's you entering a lottery that you really hope you don't win, but if you do wind up winning, you're going to be kind of glad that you do. So let's just take a look at kind of what that might mean. So if, for example, let's say I can't afford to have an emergency fund for my house, right? Most people do not have an emergency fund stashed away for the price of a house just in case it happens to burn down. So what happens? You get insurance. Now, you pay, let's say, I don't know, $100 per month. In the case of your house burning down, it will be rebuilt. Now, you don't want your house to burn down, right? But in the event that your house does burn down, they will rebuild the house for not much of a problem, and so you get a new house put back in place to replace, and it only costs you $100 a month rather than having, let's say, a $400,000 emergency fund. Most people do not have that kind of money just laying around just in case. So that's essentially what insurance is. So why should I do this? Well, usually this is to cover, again, large expenses, right? Or events that happen. These are things, again, which a person could not cover with an emergency fund, right? Now, some forms are required by law, and that's just to make sure that in the event something big happens, that they can be covered. So ordinarily right now in class, what would happen is I would have an activity going on, and the activity would be where I would get, let's say, all of you $1,000 in Monopoly money. Now at $1,000 in Monopoly money, I say, okay, who would like to pay $100 of that for insurance? Most people say, oh, yes, that would be a good idea. Some people don't. And then one person is drawn at random. And so I might take $100 from from all of you. And so I take it from, let's say, about 21 people. Actually, let's go with $50. Let's say it was $50. Take $50 because one of you is going to wind up with a disaster that's going to wipe out all your money. So instead of 1,000, you've got 950, but there is a 1 in 20 chance that you are going to lose $900. And we do it by random. We see who that is, and that person winds up getting $900 back. Now, the extra $100 that I took, that goes to the insurance company. Because these people still need to get paid and everything else, so it's not a perfect system, but if you know that there's a 1 in 20 chance that you're going to lose everything, you will want to get that money back. And so this is how insurance companies basically run their business. So what insurance is required by law? Well, first of all, car insurance. Everybody who's driving needs to have a car that is insured. And now that is personal liability and personal damages, which is really to pay for damages that are to other people, right? So if you hurt somebody or you damage their vehicle, you are required to have insurance money to pay those people back. So if you're in a car and somebody else is in a car and you run into that person, your insurance will cover the payment for their vehicle, not yours, required by law. Now, you can also get insurance for your vehicle as well, but that one is not required by law. Only personal liability, personal damage, stuff that pays for other people's vehicles. So if you get the minimum amount and you bash into somebody, that's going to be a problem. Well, you say, well, what happens if I wasn't at fault, Mr. Dunbar? Well, even if you don't have insurance to cover your car when you're in an accident, they must legally have insurance to pay for your vehicle in case there's a problem. And so that is just, so if you're in an accident and it's not your fault, you will be covered. Also, insurance on mortgages, more than 70% of the home, are also required by law. So what does that mean? Well, let's say if I buy a house for, let's pick a nice round $500,000. Okay. Now, I don't have $500,000 just laying around to buy the house. And so what I do is I borrow money, and that money that I'm borrowing is the mortgage. Now, if I borrow more than $350,000, I'm required to get insurance on that mortgage. And that's just so the bank who's lent out the money, if something happens, is not on the hook for all of that. Now, if it is less than 70%, let's say I only borrowed $300,000 on this house, well, that does not require insurance. Only $300,000 or more requires insurance by law. Now, that's not to say that you can't get insurance on lower amounts or things like that. It's just not required by law. Okay? And so those are two of the big ones. There's probably some others that are specific to fields, but that's how it works. Really, the idea again is you're taking a little money from a lot of people and making big payments to just a few people, right? So in our activity that we would have done, if we were in class, we would have each paid $50. The payout was $900, but we took 20 of these and we only paid one of these, right? And so we took lots of payments from many people. We made a few payments to less people, and so the insurance company makes $100 out of that. And so what the insurance companies will do is take a look at the risk. How often do they think they're going to need to be paying this out? And how many people are they getting coming in based on that? And that's how they're going to set their premiums, what they decide how much the insurance is worth. And so they've got a whole bunch of people whose specific jobs is to deal with that. Now you can insure about almost anything, right? But these are four big ones, four major forms. The first one is home insurance. Now that can also include renter's insurance. Now the difference between home insurance and renter's insurance is, do you own the home, right? If you're renting a house and something happens, it's not your problem to repay the house. It wasn't yours to begin with. But if you are renting the house, renter's insurance will cover your stuff in the house, and your landlord would be the one who actually owns the home insurance. However, let's say, for example, you do own the home. then you will want to get home insurance on that. Car insurance, that's for vehicles. Life insurance. Now, life insurance is basically in the event somebody dies, or critical illness insurance in case somebody's come with a large critical disease. Just a little bit on life insurance. I'm pretty sure I got a slide further on down with that, but this is really to replace your income for people who might be depending on it, right? Because once you're dead, you don't need it. But let's say if you've got children, they may need it. Or you got a spouse at home who doesn't work, they may need it, or some other dependent. Critical illness depends, well, what happens if I get something, let's say, like cancer or some other terminal illness that winds up preventing me from being able to work, and to replace that, some of that income. Now, you may have also heard with insurance the idea of a deductible. The idea of a deductible is really just a set amount of money required when you make a claim, right? So instead of, let's say, everybody who pays $50 automatically gets $900, they may say, okay, in order to make the claim, you got to give us an additional $10. So that $50, if you're making a claim, actually pay a little bit extra in order to make it go. And that's what the deductible. Now, this is to prevent frivolous claims, right? So, for example, I need to replace the carpet because my dog had an accident on the carpet. And, of course, the insurance company says, no, we're not covering that. But all of a sudden now they've got a bunch of paperwork saying that they've got to do it, and they've got to tell a bunch of people not. And so it's really just to keep those frivolous claims down. The higher your deductible usually also means lower payments, so it's just something to kind of keep in mind. Or to say, let's say if I insure my car, right? I've got a car here, and I say, okay, my son backed the tricycle into the vehicle. We should replace the whole bumper because of it. You know, the insurance company isn't going to really want to deal with that, and the people who are paying in don't want others to be taking their money just for that. So the insurance adjuster is the person who comes and says, hey, is this claim actually legitimate? You know, for example, if I've got home insurance and I'm trying to say, well, my house burnt down, they'll come and say, I should see evidence of a house burnt down, right? And again, a lot of times people think that they're mean, but you have to remember, if you're not the one making the claim, they are protecting your money. You've put money into this pool as well. And so they are protecting these people as well as the company's interest. It's not all just simply the way that we saw, let's say, in the first Incredibles movies, where Bob Parr was an insurance adjuster, right? Now, that is different than an insurance broker. An insurance broker basically says, hey, if I need to buy insurance, I go to this insurance broker. The insurance broker takes my information and will send that out to all these different companies, get the different rates, and the companies will all send information back to the insurance broker. And once they say, okay, this is what we'll do, this is what we'll do, the company says, oh, the insurance broker says, hey, pick this one. And that's the one that you actually want to buy. And because you don't actually need to pay the insurance broker, because when the company is making this rate, they're competing against all these other companies, and they know this, so you're going to get the best rate. But they say, hey, you get them to do ours, we'll pay you a little bit of money. And so a little bit of a finder's fee goes to the mortgage brokers. So, but they take a little commission, but they're actually saving you a whole bunch of money in the process. So that can be a very, very handy thing. Okay, we will continue this in a part 2 lesson in a little bit.